We might have a couple people start rolling in, but I think we're good to get kicked off here. So, welcome everyone. Thanks for joining part one of our three-part series on unpacking venture lending. The goal of this is to, over the next couple of sessions that we have, is really talk through common myths, misconceptions, misunderstandings when it comes to whether it be companies, investors, service providers, or even the lender side on how to consummate transactions. And not only that, but also make sure it's a healthy transaction all the way through the life cycle. So, James Cerner, founder, CEO of Fifth Line. We are a debt advisory firm specializing in working with growth stage and lower middle market companies. We primarily work with companies, generally sub-bankable categories. So a lot of our clients may have a cash burning profile, they may be asset light, or pretty far past their most recent equity round where they need a little bit more of a creative capital solution, which is where we come in to guide them along the way. I'm joined here by Troy Zander, partner at Manatt and Phelps. Troy, I want to give a quick intro on yourself and your practice.
Yeah, thanks, James. Appreciate that. And thanks for including me in this webinar. So, right, Troy Zander, I'm a partner at Manatt. Email is there on the screen, and that's a QR code for my LinkedIn profile. My team and I represent lenders principally that are lending to tech and life science companies and fitting essentially, James, the same profile you just identified from very early stage on into mature, including public companies. I started out as a Chapter 11 restructuring lawyer. One of the other members on my team is likewise a recovering bankruptcy lawyer. And I raise it because we try to view the structuring of deals as we work with lenders through the lens of making sure that the lender is protected, that the company is protected as well, in the event of a downside or in the event of a need for some form of a restructuring. And of course, while we'll talk about this, of course, that while the market has really been picking up in the last 12 plus months, there's still a lot of restructurings that we're seeing. And so there's still a lot of need to bring some creativity on that side of the house as well. Thanks for having me.
Yeah, thanks for joining. So I've always enjoyed our conversations when we catch up on what's going on in the market and everything, because I do kind of see both sides, but you really see what goes on the lender side of things because you're working with them on their engagements and their agreements. So I want to talk through, get your take on, let's start with, what's going on now. I think, if you look at the news, you see headlines from everything's great, you don't need to worry, to doom's right around the corner and everything in between. We have a small industry overall that I think you and I operate in. What are you seeing from the lender side on, appetite, flexibility, challenges? What are you seeing over the past, call it 9 months of the year?
Yeah, I mean, it's a great and important question. And, the short answer is that while there's still a lot of uncertainty, and the year started off with uncertainty, we went right into tariffs, and we began, I think, some of us thinking, no matter what side of the aisle you're on, well, at least we know this guy is pro-business, and last time he took office, the stock market took off, and we went on a long run. And so there was some expectation that would happen again. That did not happen, as we all know. There's been a tariff, call it wars. There's been actual wars. There's been a lot of uncertainty in the market. But even despite that, or maybe because of that, I don't know, maybe because it's been a long time since there's been a robust public market, in the last 9 months, really to try to answer your question, we've seen a really increased and robust activity in the venture lending space, both from the venture banks and from the private credit providers, the non-bank providers. In ways, I mean, we had our team, and again, my comments are through the lens too of what my team and I are seeing. That's what we know. We of course talk with other lenders in the space, and so have an idea of what they are doing as well. But we had probably the busiest Q2 that we've had in many, many years now. Q3, as we're about to close in on, has actually been a little bit off of what Q2 was, but that's not that great of a surprise given summer months, right? August has historically been a slower month that sits right in the middle, of course, of Q3. But I would tell you too that we're expecting a very robust Q4. And I think everybody is, and we'll talk about this a little bit too, as we begin to see the IPO window continue to or start to creep open. I think we're very bullish on what we're going to see for Q4. And again, that's also not that great of a surprise. Q4 is almost always a good quarter for all kinds of funding activity, both debt and equity.
Yeah. Yeah. I know for whatever kind of, indicator this might be, you and I come in at different ends of the transaction. Usually I'm coming in at the very beginning, you're coming in as it's closing. But for us, the first half of the year was actually generally a lot slower than we expected. But 70% of our activity was in June 70% of our Q2 activity was in June. July outpaced June, August outpaced July. So I think you're right about the Q4 being busy on your end. I don't know, because I know, again, you deal with the lender side a lot, but it seems like a lot of companies had their mid-year board meetings, or they were looking at the tail end of the year and realized, okay, we have to do something and start pulling the trigger, because we had the busiest summer that we've ever had. And the past couple of years, summer's been our busiest quarter typically for kickoff of new engagements, which up until a few years ago, summer was the slowest time of the year for us. What are you seeing from, to the extent that you have visibility, anything that from the company side of, timing? Is there a big urgency when, diligence kicks off?
I guess I would answer the question this way, which may be slightly different. And to be fair, the team and I, and we're a team of 7+ between the West Coast and the East Coast. What we're seeing in part is, given the uncertainty in the markets, right, is really a push toward closing your deal. So that's kind of a generic and summary statement, but the idea being, even though for the most part in our market, it's a buyer's market again, it's a borrower's market. Borrowers getting multiple term sheets from credible sources, and closing on good terms, generally speaking. There's sufficient uncertainty that if someone were to come to us, a company, so we'll represent, 80, 85, 90% of the time we're on the lender side, as you correctly say. The other 5, 10, 20% of the time in any given year, we're on the company side, right? Obviously not representing companies opposite lenders with whom we work, but we do see the borrower side of the equation as well. And from time to time, a borrower facing multiple term sheets will think, well, I'm in the driver's seat, and I'll just kick this down the road, and we'll not worry about it until it becomes a must-have. Yeah. Our guidance typically is, don't wait until it's a must-have. When it's a must-have, the sources may not be there, right? Why does it become a must-have? Because you're off plan, or because things have changed, or there's something else going on in the macroeconomic environment. And so, while we can't always make decisions, and companies can't always make decisions like lenders in a vacuum in the moment, there is sufficient uncertainty that I think the general premise is, look, if you're being offered debt, it's at reasonably good terms, you should take it, because we don't know that it's not going to be available in 3, 6, 9 months. You and I were talking as we were preparing for this, we'll have a part 2 of this webinar and a part 3 of this webinar. We're being intentionally careful about the content of those webinars, because we just don't know what's going to happen between now and then. Yeah. And that's not a doomsday sort of prophecy by any stretch. I think we both think things are moving up, as we talked about, that Q4 is going to be busy, but we just don't know what it's going to look like.
Yeah. I was thinking about, as we were talking about, how companies sometimes say, oh, I have, a couple term sheets, I can wait, type of thing. I've never seen a company come back and, if it's more than a few months, I've never seen them be better than planned. They're almost always off in some way. They might have had 1 month that was better, but if you go 4 months plus, you're almost always off plan overall. And then, sometimes lenders just get busy. We've had deals come back around that paused for a couple months, came back. Company actually was doing pretty well, pretty close to plan. But the credit committee had a bad experience with a similar profile company in the interim. They're like, well, we're dealing with one problem right now. We can't deal with a potential other problem in another one. So we're going to hold off until we see how this sector plays out.
And I think too, sort of consistent with that idea, I think we went through a period, you described, kind of how your months were and being really busy. I think we went through a period probably in Q2 where generally speaking, it felt like things were taking longer. The machine was sort of chugging, but chugging at a slower pace. And then we hit Q3, as I say, the end of Q2. And to your comment too about June, right? End of Q2. By the way, everybody's looking toward their vacation. So there's also some other, extra motivation to get their deal closed. And all of a sudden it was like, we're on fire, right? And like this thing's got to close in 8 days, 10 days, 2 weeks, and not 3 months. But in sort of halfway through Q1 into the start of Q2, we were seeing that sort of slow pace. I think, as I said, now first half of Q3, a little bit slower, vacation month, August. And now we're back into that, like, hey, this thing, in fact, just last night, we got a couple of emails from clients on deals that are, granted, these are amendments and they're companies that are faltering, to your comment as well. But it's like, we got to close this thing. There's a little bit of an upside. We're doing a little bit of a restructure. We got to close this thing by quarter end. Like,
oh, yeah.
Okay. Yeah. We see a lot of that.
I know we waited 3 months, but can we still finish by the end of the month?
Right. Which happens to be next week. That should be fine, right?
Yeah.
What
so who are you seeing the banks? So, the big headline has been banks aren't as aggressive as they were because equity has slowed down. How are you seeing the banks this year compared to the past couple of years on their activity? The only reason I ask is because we get a lot of referrals from banks, but we don't actually have a lot of bank quality credit profiles because we deal with slightly challenged profiles. But where are you seeing their activity level this year compared to the past couple?
Through the roof.
Really? Yeah.
Oh, yeah, absolutely.
Is that deal count as well, or just dollar volume?
Great question. On the bank side, I would say it's deal count and less so dollar. On the private credit side, it's the opposite. On the private credit side, it's fewer deals, larger dollars.
Yeah.
We were part on the private credit, and then I'll go back to the bank thing for a second. But on the private credit side, we closed, and this was a life science deal, but we closed what wasn't upsized, to be fair, but the headline number was $500 million.
Yeah.
Privately held company, right?
How much of that funded at close?
Yeah, that's a good question. I'll let you do some investigation, but that's exactly the right question, right? That's why I said headline number was $500 million. Funded at close, I think, which was not an insignificant number, was like 125. Now, look, part of that was a refi of existing debt and a little bit of an upside. So that's exactly the right question, right? And there are optics and optical illusions in this market in terms of this, huge numbers. But private credit, fewer deals, larger dollars. Banks, lots and lots of deals, smaller dollars. No great surprise. So look, there's this tendency to talk about the post SVB landscape, and I guess. We talked a little bit, you mentioned at the top, sort of debunking some of the myths, and that's always fun, right? Like, you and I attended the venture debt conference earlier in the year, and one of the headlines was like, well, what's going on with the venture banks? You may recall I hosted a panel with Bridge Bank, Mike Letterman, and Sean Linden from Bank of California, and Sean from SVB, and Ken Fugate from Customers Bank, right? And the general sort of theme was, we're all still fighting for the really good deals. Of course you are, right? They are. There was also, I think it was Ken Fugate from Customers who said, look, I don't think all four of us, and that's only 4 of like 8 venture banks these days, will all be here. He didn't give a time frame, but in other words, he expects that there will be consolidation among the venture banks. Look, the truth is, SVB didn't disappear, right? They're operating within First Citizens. And I made the comment, I think in year 1, maybe, or year 2 of the venture debt conference and I asked the question, is the 800-pound gorilla dead? It got this huge roar and a lot of backlash.
When we post this, I'll have to have them splice that in.
The 800-pound gorilla is dead, right? Is that fair? No. Okay. It just lost a lot of weight.
It depends how you look at it, Troy, but we're not dead. You gotta be careful on how you describe it.
No, I didn't say you're not. I didn't say you're dead. I said the 800-pound gorilla, right? The single dominant player in the market, right? Hold on. John said.
Data suggests yes.
Yeah, right. Exactly. I've come up with that little clip there, and there was some murmurings in the audience, and I'm here to tell you, those of us who forecasted the demise of SVB were wrong.
Yeah.
Myself included, right? SVB may not be the 800-pound gorilla that it was, but all of those guys on that panel, from Bridge and Customers and Bank of California, Sean Linden and Bank of California, will tell you, look, it may not be the 800-pound gorilla, it's probably 600. They still have a huge market share. So the rumors of their demise were in fact greatly exaggerated. We didn't know, but that was the fear, and I was with them. The other part of SVB basically went into HSBC, and Dave Sabo and team will tell you that by the end of the year, they're going to be in 15 global markets, innovation banking branded markets around the globe. Every time I open up LinkedIn, I see a post from Dave Sabo. Hey, I'm in Australia was the most recent one. And so, that's an institution which fall of SVB 1.0, nobody would have thought like, oh yeah, HSBC Innovation Bank. No, but now here they are globally providing and dedicated to the strategy of innovation banking for the innovation banking economy. Now, are they lending to that, super early stage? I don't think so, but I think they're trying to. And if anybody can pull it off, Dave and his team can, right? Yep. We just saw the other day Stifel, right? Stifel was one of the first movers post, SVB fall, and we shouldn't even call it that way. It's not fair because of where they are. One of the first groups that took on a group from, Stifel was one of the first banks to take on a group from SVB in that post-March 23 era. Just the other day, they announced the hiring of a whole group of life science lenders, right? Yep. So they too are lending to early and growth stage companies. So Customers, Stifel, Bank of California, Bridge Bank, which, almost got brought down just for being in the neighborhood of SVB and Signature, has been fine this whole time. Right. And continuing to make loans. And we do a fair amount of work with them. And to your question about like, is it volume or dollars? It's sort of both. Not huge checks. They're going to be smart and disciplined, but they're writing a lot of deals and competing with each of those other ones. On the private credit side, I mentioned sort of fewer deals, larger dollars, and we work with some funds that of for sure, Avenue Capital and Trinity and Hercules and Runway Growth Capital. And they too will tell you like, look, we're looking obviously for good, high quality deals, but we're not afraid to write the check. And there was an article recently, Isaac Taylor in the Wall Street Journal was talking about, and my team and I talk a lot about this, about, my words, debt having its day, but sort of debt filling the gap, being left by, until very recent times, the absence of an IPO market, and citing this phenomenon of these bigger checks that look much more like public market money. I expect that trend to continue even as, hopefully, fingers crossed, the public market actually, the IPO engine really starts to move. And I and others are sort of forecasting that we're hoping to see that. You've got interest rate cuts. We still have all that uncertainty. I will take a breath here in a second, of wars and tariffs and, lack of certainty, in the administration. But I think there have been enough LPs and investors, VC funds, private equity funds looking for exits, that too drives that behavior, drives that engine, drives that IPO market. So once that IPO market goes, even more fully, we'll continue to see, I think, bigger checks, more deals, a much more robust overall macro, sort of venture environment, which we've all been waiting a long time for.
Yeah, it's interesting. So a couple of things I want to touch on with what you were saying. So I remember at the venture.
There wasn't much there, I know.
I was trying to take mental notes along the way. I remember the opening presentation, there was a headline number on debt activity. I think it was from 24 or it was trailing 12 month. I can't remember, but it was a big number. But when you parse it out, I think I'm off on the numbers, so don't quote me on, but say it was like a 1.2 billion or something like that over the past 12 months. It was something like 200 to 300 million of that was one loan.
Yes, right.
So it was interesting. I was actually just talking a few weeks ago with one of the reporters at PitchBook who's covering the venture debt space. And, he was asking something similar. He's like, well, this number is doing this. I'm like, well, can you guys parse out, though, anything north of 150, 200 million? Can you guys parse
just take those out, right?
And he's like, that's actually a good idea. I'm like, well, also, you guys take into account the $1 to $4 million checks for those companies that haven't raised a big Series A, or haven't raised any capital before. Because if you have a lender lending to a company, a software business that is cash burning but founder funded, or maybe a couple family offices came in just to give us some seed money, as far as I'm concerned, that's still venture lending, and you're lending against enterprise value and projected future exit. And I gave him a list of a few lenders. And he's like, they're not in our system as venture debt providers. So I was going through them, like, try adding these guys in and then see what the actual trends look like. So I've been working with them on that, because we're seeing a ton of activity. We'll work with transactions as small as $1 million, as large as about 100 to 150, depending on the capital or on the need. But we're seeing a ton of activity count wise in that $3 to $7 million range, whereas last year it was a $25 to $35 million range. And now we're just seeing a ton of companies coming like, I just need $4 million.
Yeah. Well, I mean, you're exactly right. If you throw out the outlier numbers, all of a sudden the numbers look different, right? I was doing a little bit of research too on just historic data, call it 2020 to 2025, number of US IPOs, operating companies, right? And of course, PitchBook, as you mentioned, is the best source. But then you have to go, well, do we want to include SPACs, or are we not including SPACs? Are we including secondaries, or are we not including secondaries, right? And the numbers, so I'm sure somebody from PitchBook would tell me that I'm wrong, but even with PitchBook data, you have to be very careful to parse the data to see what did you ask for, and what's the data that you got, and so what does that reflect? But you're exactly right. On the one hand, you sort of have to throw out the outliers. On the other hand, there are those of us, including that lender that wrote that deal, we as the lawyers who get to put it out on LinkedIn and hey, we closed this $500 million deal. We still want to be able to say, they do, we do, the company does, right? Keep in mind, the company likes to boast about a $500 million deal because it's window dressing, because they're public, they're private. So when they go public, they want to be able to post to the world, to the potential investor world, we've got this $500 million credit facility available, wink, wink, right, to us. So everybody wins, but we have to be really careful about how accurate is the data and what's the data actually telling us. But you're entirely right that huge number that was posted really reflected about 5 very large deals and about 10 much, much smaller deals.
Yeah, we're seeing a lot of companies too actually ask for more delayed draw structures. So they might ask for a $20 million facility, but they're like, can we only take 7 at close? And I'm hearing from lenders, a lot of them are saying, well, we have to structure a certain way, because if we make it, fully committed, regard upon a milestone, we have to report that we, committed all this to our LPs, but we're not making money on it. It's just sitting there. And most companies, they find over the past couple of years, haven't come back for it because they haven't needed to. They've either upgraded to a cheaper cost of capital, or they have actually done subsequent equity rounds, though they're not the $50 million equity rounds of 5 years ago. They're more responsible, in my opinion. They're just raising what they need from investors that just need to put some growth capital to work. But you see these big headline numbers, and lenders that I've been talking to are saying, we don't want to just commit it. We want to go to work. We want to do something. And then when they come back and need more, we can give it to them.
Well, and you know this as well, and your borrower set, I'm sure, knows this too. When you're talking to a bank about making available a delayed draw kind of facility and committed, they have to reserve capital for that. And so they don't want to do that. Why? Because if the borrower's never going to use it, then they've reserved capital, which they can't deploy elsewhere. The sort of cost for the privilege of that delayed draw facility is going to be some version of an unused fee. So the borrower, the company, has to weigh, how important is it for me to be able to tell the world I have this $20 million facility, right? 7 of which is funded and 13 of which is on a delayed draw kind of notion, and the cost of capital. Because the bank, in this circumstance, the bank that has to reserve capital, isn't going to do that for free. That's not the business that they're in. And as you know too, that's not where they make their money, right? They're still, so even as aggressive as the banks are getting, and the banks are aggressive, and I think they would tell you the same, in some respects, much to the chagrin of each other, right? This one looks at that one and goes, what are you doing? That one looks at this one and says, why are you doing that?
All the time.
All the time. But what do they really want? Where do they really make the money is treasury, right?
Yeah.
What they really want is the deposit. Still. With some exceptions, right? Look, to their credit, and no offense to any of the others, and this isn't a commercial for anyone, it's a matter of fact, HSBC can better stomach making the loans to these early and growth stage companies without the need for the deposit. Why? Because they're this global financial institution, which isn't looking at any individual borrower's deposits in order to stand behind the loan. Not all the banks in the venture landscape can make that same claim. They're much more deposit, sort of requirement heavy,
It's
which
a big
again, no great
challenge
surprise.
too. Yeah, it can
Say
be a
again?
friction point for a lot of
Yes.
companies. Because it's very rare I talk to a company and they don't like their bank. It's almost always they just won't lend to me. But I like Steve. He's great to me. He's awesome. I have 28 vendor accounts and 100 customer accounts that I'll pay there. I don't want to deal with moving it. So even especially as the gap between bank cost of capital and private credit over the past few years got a lot narrower. I saw a lot of companies just say, look, I'll pay a little bit more. I'm not moving all of my stuff over right now.
The good and the bad news around the banking side of the equation, you're exactly right, is that banking is extremely sticky.
Yeah.
Right. And so once you're there and you have your banking relationship and it's pretty good, it doesn't need to be excellent, doesn't need to be the best, has to be pretty good. It's very tough to move it. Right. Private credit doesn't have to worry about that, right? Do you have a bank that will give us a control agreement? That's private credit's view around the banking. Are your deposits safe? We're having fewer and fewer conversations these days about oh gosh, we're afraid about your deposits all in one institution. Sure, it's just a good idea generally. Side note, parenthetical, that you should diversify your deposits. You, James, should. Troy, should. The rest of our participants should. Companies should. But not as a matter of extending credit. Not as a matter of great fear around banking crises. I don't think. But private credit doesn't care. They're not offering banking services, right? It's the banks, and so bank that's the incumbent bank says, look, I can't make that loan to you on those terms. Company, just exactly say, is much more likely to say to next provider, but look, I got to be able to keep my deposits there. Why? Because it's just sticky and it's just a lot easier to keep it. It's not lazy.
Yeah, it's always a convenience thing. I just don't want to do it.
Right.
Yeah.
Right.
Because as someone that I didn't have to do it for us, but we set up another bank account to secure some financing about 18 months ago. And we're like, look, I don't want to move everything over.
Right.
It's just so difficult. You need to update wiring sheets, instructions, bill pay, all the things.
We're talking to a company right now, private company, a global operation. They're looking at, it's a much different profile than we're talking about generally, but in the entertainment industry broadly, and they're looking at taking down what will ultimately be a $300 million syndicated facility led by a large global financial institution, not one we've named so far. And what I have told them in connection with as borrowers counsel, among other things, this institution has a very large investment banking arm, right? They want to be the one on the book to take them public, but also and huge fees, right, to the investment bank on that exercise, but also they want their global treasury. Right. And so what I have told them is that as you look at the term sheet and you satisfy yourself that you can live within and grow within this credit facility as it's being contemplated, understand that your sort of best negotiating leverage is, you want the deposits because why? That's where they make most of their money, is on the treasury. So a lot of money on the investment bank for sure, but there'll be more than one on that book, right? At the end of the day, it won't just be that institution, it'll be another one. So they'll have to share it anyway. It's really the treasury. And of course, the conversation that I'm having as borrowers counsel too is, look, but you still have to make sure that the services that you're being provided by that bank, and this is the same whether it's a $300 million facility to a global enterprise or an early stage company with a single bank account, that you're able to get from your banker the service that you expect. Here's the good news for that early stage founder. The banks are not quite falling all over themselves. I don't want to suggest it pejoratively, but understand that dynamic and understand how hard it is to move the deposits. It's not easy to keep them, but it is sticky. And so the borrowers, the depositors, companies win there too because of the service level, generally speaking. They're not all the same, but they're all fighting for that same piece of business.
One question I have for you. So you mentioned essentially, more or less borrower leverage during the conversation with banks, but let's expand it to banks or private credit. What are you seeing when you come in to negotiate the final agreement? What are you seeing as far as a gap between borrower and lender and expectations? And the reason I ask is I'll share my perspective afterward, because we see a lot of, we see both sides of it. Companies will come and say, I can get this. Wow, I did not think that'd be an option because I haven't raised equity. We have just as many companies that come in and say, no, I'm not agreeing to all these items. It's like, okay, well, where are the other term sheets? Oh, well, we already talked to 28 lenders. They all turned us down. Okay, well, that's the market telling you something. So where are you seeing, how are you seeing that pan out? And is it different now than it was maybe a year or two ago?
So let me, I want to answer the question, but I'm going to answer it as
Okay.
I'm a lawyer, right? So I get to sort of answer it the way that I want ish, but redirect, right? So it is our experience, my team's and my experience, that it appears very much to be a borrower's market. It's not unusual for us to hear, and by the way, we'll get involved sometimes at the term sheet stage when the term sheet's being negotiated. Some of our lender clients will say to us, hey, can you take a look at this term sheet? Of course, when we're on the borrower side, they're definitely saying, hey, can you help us look at this term sheet? When we're on the borrower side,
the lawyer negotiates the term sheet.
It's painful. Look, we know the experience, right? Doing so much of the work on the lender side, we try to be really judicious. We will counsel our borrower side clients really to push only for the stuff they actually need. Don't try to make this the perfect deal. There are plenty of lawyers you can ask who think that they're adding value in that exercise. We don't take that view.
Isn't market.
Isn't market. Or by the way, we make the market. That's what I love, But it's not unusual for that borrower in that scenario I described, where they come to us and say, hey, can you help us look at this or spread the term sheets, right? Where they are down to 3, 4, 5 term sheets where they actually had 12. Now, look, not every company, right? Every lender still has their discipline, their credit underwriting, their boxes, as it were, that they have to check before they'll commit to a facility. But for the good companies, lots of fighting over those good companies. All of those banks that I described, Customer, Stifel, Bridge Bank, HSBC, Bank of California, et cetera, even Comerica will give a term sheet to the right company, the right investor syndicate, the right management team, the right product or service. And so it's not unusual, as I started to say, for that borrower to come to us and say, well, look, I've got 4 term sheets. They all look pretty good. I had this just a couple of weeks ago. Company AI, company algorithmic, doesn't really matter. They all have to say AI these days. Wink, wink. Said, look, I've got 3 good term sheets, and here are the institutions. And I was like, look, these are all really pretty good, and I can help you slice and dice. I'm going to turn it to a slightly different direction, right, James, in response to your question, because this is real from this example.
Yeah.
What I said to him was, and you alluded to this earlier, was, look, these are all great term sheets. They're all from good institutions, ones I've named this morning. They're all very close in proximity, sort of total cost to the borrower. What you really need to think of is, how are they going to behave when, not if, but when you hit that negative inflection point? Who's going to be your best partner at that stage of your relationship, right? Everybody is behaving on their best behavior when we're walking in the door and we're signing term sheets and, hey, we love you, and, blah, blah, blah. But when you hit a negative inflection point, and by the way, you should plan on it, company. I don't care how well you're doing, unless you've got equity lined up for the next 18 to 36 months, you should plan that you're going to hit a negative inflection point and be thinking about, how is my lender partner going to behave? And that was really the analysis that we went through with that borrower, who, by the way, is sitting on a pile of equity they had just raised. They're taking on debt. The CEO told me, I don't really need the money. And I said to him, well, then why are you doing this, by the way? Yep. Contrary to what I said earlier about, like, take the money, different situation, sitting on a bunch of equity raised. But there are reasons that he wants to take it down. But that was the conversation. How's your banker going to behave when you hit a negative inflection point? And that's really how you should be thinking about who your banking partner is. So I don't know that I quite answered your question. I told you I was going to take it in a different direction. Hopefully not too far off
it
track.
makes sense. So we'll get called in sometimes to help primarily private credit funds and banks alike, actually, to help with refinancing, or sometimes just to help get the ship back on course. The number one issue that we run into, it's very rarely, it's always some sort of financial underperformance, right? Sometimes revenue, liquidity, whatever it might be. The main reason when we're talking to the company, or excuse me, the borrower and the lender, is communication. Yep, they reported, and this and this happened. Well, that happened with another company. What happened? Well, they gave us a heads up. Okay, we go to the company. Hey, what happened? Well, we weren't sure how to explain to them. Well, they didn't tell us how this would happen. So the number one thing, because I know we did talk about how some tips, tricks, and general advice and everything. Communication, honestly, I preach it internally to my team for everything. But with the clients, I always preach to them, hey, just communicate. Because I do get that question. Well, what happens how are they going to do this? What happens if this covenant breaches? I say, look, I can speak specifically to this lender because I know them for years. I know how they operate. I've had clients that trip covenants with them. I've had clients come to us from them. But, what happens every time is it's a conversation. The second, very rarely do you not know that you're going to trip up. Very rarely do you not know that you're going to be late on reporting this month because your controller had an emergency. Communication, quick email, text, phone call. Honestly, I found solves 90% of problems before they arise. And that's what I try to explain to every client is there's paper and then there's reality. I don't know, years ago, I remember it was probably like 10 years ago. I remember the joke I used to say is, well, have you ever read your iTunes terms and conditions? They're pretty strict. Your credit card terms and conditions are pretty strict. You still have a credit card, you still use iTunes. So it's kind of in that same regards, and that's where a good lawyer can come in and say, look, this is what will happen, if I phrase it as basically if you give them a middle finger, if they ask you questions, but if you communicate, it's not in anyone's best interest to call their capital back. It hurts their return and it hurts their reputation.
Look, even so, agree 110%. And it actually starts before they've formalized the lending relationship, right? You and I were talking about this. Oh, the night before we're supposed to close, or the day before, or the week before. Hey guys, here's a revised plan. Are you kidding me? Come on, like you didn't know you were going to need to revise your plan at least a couple weeks ago? So that's not the way to start off a relationship. And by the way, that's what this is, in much the same way that ours is a relationship with our client, whether that's borrower or lender. Yours is a relationship with your borrower or lender syndicate, right? The company's relationship with their lender is exactly that. And in many respects, those lenders want to be your partner. They're not your enemy. They're giving you their money. They expect it to be repaid. It's an investment. It isn't equity, but it's their investment in you. And everyone we've talked about, and even some of the others, Runway, Hercules, Trinity, Avenue, Horizon, they will all tell you, look, our value isn't in lending. And by the way, the banks as well. Our value isn't so much in lending you the money. It's in the relationships that we can help you build and establish and develop. From developers to potential equity investors to, fill in the blank. And by the way, including how to think about what your treasury management should look like, or what other products you might take on from that bank or deliver, or, hey, we have this other company in our portfolio that, you might be interested in partnering with or acquiring, right? So the borrowers need to understand that the lender is trying to be their partner. They're not trying to steal anything from you. They're trying to advance you, right? And by the way, in some respects, the warrant equity coverage in a lending transaction is sort of evidence of that. Even though the coverage amount has gone really down from the lender's perspective, tiny little warrant coverage, part of that warrant coverage is us saying, we're investing in you. We'll work with private credit providers, right? Oxford on the life science side, and Horizon does this, and Hercules does it, Trinity, Avenue, where they will even build into their lending facility an ability to convert a portion of the debt
Oh.
into equity, and
Yep.
or to buy equity separately without conversion. So why am I saying all that? The borrower needs to understand exactly as you say. You've got to be open and honest and direct with the lender from beginning through. You can't wake up on the day that your compliance certificate is due and go, I'll just stick my head in the sand. They'll probably never notice. No, they're going to notice, and then it's worth, right? So,
Yeah.
so if you knew the Monday before the Friday that your compliance certificate was due that you're not going to be able to deliver it on time, just pick up the phone. And by the way, pick up the phone. Don't email them. Pick up the phone and call and tell them. And by the way, they're not going to be surprised. Look, we always tell the lender, from time to time, the lenders will ask us to give their teams like training.
Yeah.
And the corollary to the communication piece is the lack of communication. We will tell lenders, and particularly on the workout side, or as they're thinking about that, look, you're less concerned when you're hearing from them regularly. You're more concerned when you stop hearing from your borrower, right? And so they're late on the first compliance certificate. The second one is even later still. The third one is even later still, or doesn't arrive at all. By the way, if you're at that point and you lender haven't picked up the phone and called your borrower to say, hey, what's going on there? That's a misstep on the lender side.
Yeah.
But they've got to be in constant communication, because otherwise what happens is a potentially very negative result to the borrower. And by the way, as we all know, it's entirely likely that there's a rational explanation for why the compliance certificate was late, like our finance person was sick or whatever it might be. And so that just needs to be communicated. You're exactly right, James. Communication is the key. It's the key. This is an investor relationship, right?
Yeah.
I mean, not investor equity, but they're investing in your business. And they expect you to be respectful. That's sort of part of that.
Yep. All right. So we have about 8 minutes or so left before we leave some time for questions at the end. I do want to talk through. So we talked about what's going on so far this year, past couple of years, general, both sides of the equation. So, founders in particular, they're looking at, what financing options might be. Let's assume they range anywhere from $1 million SaaS company to $100 million plus consumer goods business. What would you say the expectations from their end should be? And if there are different profiles, like, hey, if you have this, expect this type of thing. But what would you say they should be on the lookout for between now and the end of the year if they're looking at raising anything?
Okay, great question. And there, like one of my comments is a lot to unpack there. I was talking to, I mentioned it before, and again, not a commercial for any particular bank, but I think it's illustrative of how many of the venture banks anyway think of this. I was talking to Mike Letterman at Bridge Bank, and we were talking about founder expectations, early stage founder expectations, and how founders think about the debt raise in particular, right? And he said, and this is almost a direct quote, first-time founders of early stage companies need to be cognizant that this is debt, not equity. It needs to be repaid. And if you don't have a plan B or a plan C for repayment, like equity, don't take the debt. And it's really important. And, we've had experiences, my team and I, where there are cultural issues to navigate with founders. And I'm not picking on any particular group, but where there is a sort of a cultural disposition that this is, when I use the word investment, that this is an investment, that means equity. I don't really have to worry about repayment. This is debt. That's a different instrument than equity. So that's one piece, is like, look, have a plan and make sure you're communicating along the path toward what your capital raise is. That's maybe number one and two. As we think broader, including as we move into Q4 and into the end of the year, I hope I'm right, frankly, for personal reasons like my 401k, but also for the work that we're doing in this, ecosystem. I hate that word, but that the public markets are going to return, are going to be robust. I mean, we're already starting to see it. I think there have been more IPOs, true IPOs in September alone than there were in like Q2 and maybe in so we think that window is opening. If that continues and the prices stay north of initial price, we think that that's a rising tide situation for everyone, right? Like rising tides raise all ships, and we make that go away. And if that's right, then the opportunity actually to raise debt will be greater. We sort of take the view, our experience is that the private markets always follow the public markets. And so as the public markets continue to gain in traction and we continue to see activity, capital raise, et cetera, that sort of makes its way down, including to a willingness of those same LPs who are cashing out in that public market to invest more in the private market to drive that private market ultimately toward that public market. And you get this virtuous cycle, and you get this flywheel effect.
Mm-hmm.
And so, but that doesn't happen without planning, right? You can't just show up and go, hey, the market's great, give me a $5 million debt. No, you have to have your ducks in order. You have to have a good business plan. Again, these days, as I mentioned earlier, jokingly, you have to have AI in your deck. Work with an advisor. If you're a borrower, work with James and his team about what that presentation to the lender, sort of landscape needs to look like. What's included and what's the actual sources and uses, not just the fact that, well, we need $5 million for what, right? So have a plan. Proceed in parallel path, debt and equity, if you're in a position where you can raise debt and or equity. Oftentimes the two are complementary, one of the other. And frankly, back in the day, a company would raise equity and then was bankable. You use that word. They became bankable, then they raised debt, right?
Yep.
That strategy has changed somewhat. These days, debt is, in a way, a necessity given what's happening in the equity markets, but we think that that's starting to change with that increased robust activity in the IPO market.
Yeah, we're seeing a lot of lenders over the past really couple of years. When you're mentioning having your ducks in a row, that's been a big priority for them because they don't want to deal with headaches down the road. And what they've been finding in the conversations been having, especially for those lending in that $3 to $10 million check size range, is they're caring less about the cap table and they're focused more on the business fundamentals. If you're a SaaS company, what's your revenue retention? What are your margins? How's that trending? Which again ties back to having your ducks in a row. Being able to report on basic things, knowing that you need to report on them. I've had companies before when I first started talking to them say, okay, what's your revenue retention? They give me a number and I just look at their financials. I'm like, that cannot be accurate. I get the raw data and they just were completely off. And you have to explain this is why it's important because, and you explain why it's important to the lenders. I'm like, okay. But, when they go to a lender and they say, well, we don't look at that. We don't care about that. That's not having your ducks in a row. You need to know what lenders will look for, what you should be looking for. And this is where investors as well in companies, especially seed and Series A investors, should be well-versed in knowing what other capital providers, because growth equity guys, we see look at the same metrics. It's even deeper. You need to know what you're doing. You need to know what you're looking at. So I think that's where, companies, when you are looking at on the equity side, how can that investor help you at the earlier stages beyond just writing a check? And then on the credit side, do they know your business? Do they know, are they asking for things that have nothing to do with you? And it's clear they don't know that. Or think twice, are they actually asking for stuff that maybe you should be keeping an eye on if you're not already?
Yeah, totally agree. So it's about 10 minutes before the hour. We have one question in the box. Should we read the question, see if we can respond to it?
Yeah, definitely. All right. So forgive me. I've actually never been the one to manage this. So I think that,
I got it. I got it up on my screen.
Oh, perfect. All right. Excellent.
Yeah. So this guy goes by Houdini, and his question is, in connection with the negative inflection points that Troy mentioned earlier, when a venture-backed borrower stumbles, misses milestones, struggles with a down round, or defaults, in your experience, what legal remedies are most practical for lenders, and how do you counsel clients to balance enforcement with preserving enterprise value? Gosh, that's a great question. Look, my team and I almost always take the view that the negative inflection point is an opportunity to get everybody back to the table. What does that mean? That means let's try to negotiate toward a solution that works for the borrower and works for the lender. And again, this is sort of both sides of the equation, and goes back to your comment about communication, right? If the borrower is going to miss a financial covenant, the borrower should get well ahead of that. You made the comment, James, and you're entirely right. Look, the borrower knows. We call it sort of that information about the missing of the covenant is sort of uniquely within the province of the borrower. The lender doesn't know. The lender is waiting for you to report, right? So it's really important to get ahead. Why does that all matter? Because that then gives you the opportunity to come back to the table, sit down and say, hey, look, that covenant is too tight and we need some relief on the covenant. By the way, come with a plan. Part of the communication is for the borrower to go, but look, we're not looking to just get rid of that covenant altogether. We need 3 months of relief. And here's what's going to happen in that 3 months. Come with your plan, blah, blah, blah. Why? Because again, this is a partnership. Your lender has invested their money in you and wants you to continue to succeed, grow and succeed. Isn't putting covenants on you, by the way, that hopefully that came out of thin air or that you didn't think at the outset you couldn't perform to. If that's the case, you should have had a conversation then about that. So this is now that negative inflection point to the question is a great opportunity to come back to the table, sit down, figure out whether there is a path forward. Now, look, sometimes there isn't a path forward, not at the first negative inflection point. You miss a financial covenant one time, again, could be a rational explanation. Hey, we had some seasonality, or hey, this account debtor paid late, or there might be a rational explanation. Your lender doesn't know that until borrower, you communicate that to them. Point number next. As primarily lender side of the table, James, as we've talked about, we will oftentimes say to the borrower or their counsel when they say, well, this is, you're trying to trick us or trap us, or that's a footfall. We don't really want. No. Look, what does the lender want? The lender wants a performing loan. We don't want your assets. If we wanted your assets, we would take a different approach to the structure, right? What we're really looking for is repayment of our principal, some coupon, and maybe there's some fees that go with it. We really want you to hit the home run. Why? Because we want that 12 basis points or 25 basis points warrant coverage to actually be meaningful. We want to support you as you grow. But look, the lender too, whether bank or private credit provider, makes bets. That's what they do, right? Law of averages. Not quite, just like the VCs, right? The VCs know that they have to make a bunch of bets, and they're not all going to be home runs. They're going to have a few singles. They're going to have a bunch of doubles. They'll have a couple triples here and there. It's just like baseball. Once in a while, they'll hit a home run, few home runs in a season. Once in a great while, they'll hit a grand slam. Bank is sort of the same way, different mentality. They're not looking for the return on investment in that same way, looking for a much more modest return. Principal, interest, the coupon, the fees, that's it. Do well. We want to double, or maybe it's a single off of our warrant coverage. So the goal is come back to the table sooner than later. Borrower, you own the information. You own the ability to redirect. If your covenant's too tight, come back and make a proposal as to what it should actually look like. It's a great question.
I do want to talk a little bit for the other prospective borrowers on the call. So what happens before you get to the legal remedies? Like Troy was saying, communication. You talk to them, you give them a heads up. Very few people do that. So what happens? You miss that covenant, you report late. Most lenders, like Troy mentioned earlier, should be calling you. What's going on with this? Where is this? It is important to understand that whether it is covenants that they're structuring in terms, finalizing in the final agreement, or managing those covenants ongoing, lenders want very few things less than actually calling their loan, getting their money back. Any company loves a land and expand and a repeat customer. They do not want to have to conduct diligence on another company just because they got refinanced out of a good one. So it's always important, and I say this for both because we do counsel both borrowers and lenders ourselves whenever there are challenges is, communication on frustrations, challenges, questions, concerns. Most of the time, Troy, you made this comment earlier, everyone's great and happy and go lucky in the very beginning. It's kind of like when you first started dating. And then a couple years in, you hit bumps in the road, and that's when you see how people really will behave and perform in those situations. So it is important, borrowers, feel free to do background checks on borrowers or reference checks. We have a lot of clients that do that. Say, hey, can we talk to a few prospective or a few existing or past borrowers? And lenders are happy to send you their tough cases because they like showing it's a relationship business. They like showing how they perform. And, don't be surprised if lenders hold firm on something because there's a good chance it has nothing to do with you or your company. It's their LPs. It's what they agreed to with their LPs for certain performance. And their job is to make sure that, you stay within the guardrails. Most lenders will structure pretty wide guardrails to give you a lot of leeway, and they're going to work with you before you get to a legal. Last thing on that, I had a lender I've dealt with for years share with me. He's like, I've been in this business 28 years. Not once have I pulled out a loan agreement. He's like, if you have to pull out the loan agreement, you're past the point of remedies. You should be able
I
to
agree.
say, we know what we agreed to. What happened? This happened. Okay, great. We know what you think is going to happen. Let's put a little bit of buffer room. I don't want to deal with the workout. It's not good for you. It's not good for me. Let's make sure we get back on track. And then, let's talk maybe twice a month instead of once a month going forward, once a quarter. So again, I hate to say it or beat a dead horse, but it does all come down to communication.
Yeah. And we'll talk down the road. We've got, 2 more parts to this webinar series. And, at some point we'll talk about things like the MAC, event of default, investor abandonment, and equity cures, and not to get too far afield. We will oftentimes talk to lenders who will say, well, look, we really love this investor syndicate, but we need to have a MAC because that's just the expectation. And, my team and I will sort of say to that lender, but well, wait, if you're relying on the investor syndicate and MAC causes heartburn, just does. It's accepted these days, but it just causes heartburn. Then you should really think about an investor abandonment provision, which is a substitute for those who may not know for the MAC event of default, not the funding MAC, the MAC event
and
of default.
Clarifying what defines investor abandonment. I've had that issue come up a few times.
And I was going to say, in its broadest sense, the idea is the investor is going to, quote unquote, certify to the lender at some inflection point, like, hey, we're still here, we still have dry powder for investment in this bar. It does not necessarily mean, and we're going to fund $12, in 37 days, but it sort of approaches that. But the corollary too, which doesn't really find its way into venture debt, certainly in bigger deals and in middle market deals, is this notion of an equity cure. If the lender really likes the investor syndicate, they should be prepared to consider for the right borrower an equity cure provision. What does that mean? Well, you miss your financial covenant, but look, we're going to give you 30 days to go out and raise equity to sort of fill that gap and cure that financial covenant. And what does that do? That also aligns interests, right? It shows the borrower is able to show the lender that I have the support of my investor syndicate. If things go sideways, they're going to step up. And likewise, it has the investor syndicate saying to the bank, yes, in fact, we continue to support this company. We're comfortable signing up to an investor support arrangement. So anyway, we'll talk more about that down the road.
That might be a good one for part 2. We can talk through, paper versus reality on term sheets, and because you and I deal with it all the time. People look at it like, what is this? And then you explain the reality. It's like, okay, that makes more sense.
So thank you, James, for inviting me to be on this webinar. As you just mentioned, the audience and others out in the verse should look for future announcements on part 2 and part 3 to come. But I would remiss, you had mentioned it's like dating, and I agree with you that it's like dating, but sometimes dating turns into marriage.
Yeah.
So our audience should know that James got married this last week. And that's a big deal after dating his now wife for 5+ years. And so congratulations, James.
Thank you very much.
And I'll see you next time.
All right. Sounds good. Thank you. Have a good one.
Thanks, James. Thanks, everyone.